Okay, it's 11 o'clock. I hope everybody can hear me all right. This is slightly weird because my computer at home is kind of frozen. So I'm on my iPad and David is in control of the slides. So if we go to the first slide, please, Dave. Thank you. So news this week, not very much. We are definitely winding down towards Christmas. I just wanted to have a quick look at Edinburgh Worldwide's results. They came out this morning. And then look at our latest new addition to the sector, which is ThomasLloyd Energy Impact. So Edinburgh Worldwide first. These results aren't great, as you can see there, but I suppose it's all a bit relative, really, because an NAV return of 18.3% is not bad in most periods. Obviously, the premium came off a bit, so the share price return was only 11%. They are quite a long way behind the S&P Global Small Cap, though. This is basically a knock, though, in what was otherwise quite a decent track record, as you can see there. So since they adopted this Global Small Cap strategy in 2014, the NAV is quite a long way ahead. So what we've done really is give back some of the performance, great performance of the last couple of years. Next slide, please. This is the normal share price and discount chart. One of the interesting things I think is that despite this underperformance, the discount hasn't really opened up. If you have a look at the next one. So here it stacks up against its global small cap peer group. You can see they're all quite big. It's the only one trading on decent premium. I suppose with Smithson's 0.8, and that's really shitty stock too. I don't really understand, given the relative performance, why Herald and even BMW global smaller companies are trading on discounts, because they are doing so much better, especially Herald, which is, you can see those numbers down the bottom there. So seems a bit strange. I don't know whether, given the current underperformance, whether this represents a buy or not for Worldwide, but I'd be much happy to pick it up if it was trading at a discount. So go to the next one. One of the things that they've announced in these results is that they want to increase the unlisted exposure again. So at the moment, at the end of October, they had 12 assets, which is 10.8% of the portfolio. And that's up from 9 a year before. Obviously, you can see 12 to 9, but a much bigger jump in the NAV proportion. And that's because they've had some decent performance from this part of the portfolio. So they want to up the cap on this from 15% to 25%. That requires a shareholder approval. So that's going to be put to shareholders at the next AGM. Part of the argument for that is in that chart there, which doesn't really make a lot of sense unless I explain it. But basically, they're saying they looked at all of the private companies with valuation greater than 500 million. And back in 2006, they reckon there were 18 of those worth about 18 billion. And now they reckon there's 923 worth 2.2 trillion. So you can see that the size of the unlisted market is huge. And that's as big, really, as the listed pool of listed investments that they're fishing in as well. So that's why they say they want to do it. So we have a look at the next one. This is what's been driving their returns. One of the big contentious things, since this is a global small cap portfolio, is that Tesla is one of the biggest, what is the biggest holding. It's also, though, the biggest driver of performance. So there's a chart in a minute I'll show you which actually breaks this down. Quite a broad spread thing of those things that are going up. Including Oxford Nanopore, which we know because that was in the Schroeder UK public-private. And the things that are going down, they make the point, actually, that all of these are things that they made decent profits out of before. And we're including in that things like Ocado, which really, they're not doing so well because they did so well last year. So as everyone was sort of stuck at home with lockdowns, people were ordering food online. As soon as we opened up, that sort of eased back a bit, and these things sold off. It doesn't really seem it seems a bit short-sighted to be trading things that way, because it seems like the trend is definitely going in their favour, these things. So they're going to be hanging on to these sorts of stocks. The other thing that made it go down was China, because as we know, the clampdowns in China, and especially on the big tech companies, have changed the sentiment there. If you have a look at the next page, please. This is a bit small text, but this kind of breaks the whole top 20 down. You can see how much money they've made or lost out of each of those. So the real big contributors there, PsiQuantum, which is one of the unlisted ones, it's a big one of those. This is the quantum computing company. Tesla's up there too, and QuotedData's. And then you can see the things that are going down there too. So Teladoc is another one, a bit like Ocado, where people were accessing medical services online, and then when they could get to their GP, that sort of reversed a bit. We've also got Chegg there, which is one of the ones that's in the BlackRock portfolio, and again, that's been a detractor in its portfolio this year as well, which is the online educational stuff. And again, that seems to be people going to work rather than doing sort of study to try and get a better job. But this is all kind of early days, and it also feels to me like a bit sort of short term. So I think what I'm trying to say, and to sum all this up, is the results don't look great on a relative basis, but they're not too bad on an absolute basis. And it feels like a lot of this is temporary. So we're just going to have to wait and see what happens next year in terms of sentiment, whether the thing will rebound again. But I still quite like Edinburgh Worldwide. It's one of the things that I hold. Anyway, enough of that one. Let's have a look at the next one, please. So this is the 22nd London listed renewable energy fund to hit the market. And it's raised just $150 million, which is obviously quite disappointing. But it's probably just about enough to make it work. And I think there's a reasonable chance it'll expand if they can deliver some decent performance early on. So in terms of the cash raise, it's only $115 million, $115. The rest of it is coming from a issue of shares in exchange for some solar assets that are owned by an associate of the investment manager. And so that's 34.6 million. I was not clear whether the manager put in any more money apart from that. We know that the government were going to back it through this mobilist thing that they announced at COP26 too. So we think that came in, but we don't know how much that was. That was supposed to be up to £25 million. So it may be that the third party money is really not very big here. It's going to be interesting when we have a look at the register when that starts to get announced. So opening price is 35.8p, which is based just a dollar listed exchange rate on today. We'll look at the next one. And these are the things it's buying. So the stock swap thing is Solar Arise, which is 7 solar projects in India. And most of those are already operational. There's another seed asset, which is 3 solar projects in the Philippines that was lined up to be bought with cash. It'd be interesting to see whether they'd still do that. I think they probably will do. So that would have actually then deployed quite a chunk of the money really more straight away. And then behind that, there was quite a deep pipeline. So I think it's quite possible that this thing will get invested really quite quickly. And if it can get invested quickly, then the yield targets that we've got there may be able to come through much faster. So we could actually see high dividends up front. If we get high dividends up front, I think you'll probably go and trade at a decent premium, and then there's a chance that they can expand it. So we'll see what happens, but I think it's not all bad news, despite the disappointment on the amount of money that they raise. Okay, that's enough news for now, and now let's